Keeping track of all risks that your company can face can be tricky. From natural disasters to human interventions, it's important to get a grasp on what a business might have to deal with. It's for this reason that a number of firms are turning to big data solutions to help them track potential risks. Risk management companies are using big data techniques to model the kind of events that a company could potentially face, as well as what the economic outcomes of this would be. A leading risk management company in the US spoke about the kind of questions that their customers deliver. These include how can they measure the amount of risk they face, how can they make sure they have enough money behind them in case a disaster should take place, and how can they reduce their risks. Using such big data techniques can also help larger companies to keep track of their supply chain risk. For example, if they have a supplier working out of an area at risk of earthquakes or tsunamis, then they can see the kind of impact such an event would have. Sometimes it can be difficult to track the level of damage natural disasters can have. Indeed, after Hurricane Katrina in the US, businesses realised they had to change the way that they measured the amount of damage such events could cause. Whereas in the past, businesses would look to the size of storms to determine the outcome of a disaster, now they're using more sophisticated data sets to calculate the economic impact of these occurrences. These calculations were not possible before the emergence of big data, which has been growing in prevalence over the past 5 years. The technology is being used not only to map risks, but has also grown in popularity for a number of other reasons. For example, companies can use big data to keep track of emerging suppliers they may wish to work with or technologies that could prove useful to their work. This story was brought to you by QBE, the business insurance specialist.